Hello, and welcome to this week's Stearns Financial's Let's Talk About It. Today, we're going to be discussing 5 trends for the next 5 years and how they may affect investment strategies. My name is PJ Williams, and I am joined today by Glenn Joyce, Stearns Financial's Co-Chief Investment Officer. We are fortunate today to have Doug Peta as our special guest from BCA Research. BCA Research is an independent provider of global investment research. Since 1949, BCA Research's mission has been to shape the level of conviction with which their clients make investment decisions through delivery of analysis and forecasts of all the major asset classes and economies. The firm maintains offices around the world. Doug has been with BCA since 2010 and is currently their chief U.S. investment strategist. He previously led their global asset allocation service. Prior to BCA Research, Doug spent over 20 years as a strategist, analyst, and trader. Thank you for spending some time with us this morning, Doug, to offer your insights. So let's kick it right off, Doug. On this first slide, let's discuss fiscal policy.
Sure. So we think that when we look back on 2020, that financially and economically, the pandemic may not be the first thing we talk about, but that 2020 may have represented a really important shift in both monetary policy and in fiscal policy as it's practiced in the United States. And this slide gets to the fiscal policy in that the way we look at it in terms of fiscal policy is that the Reagan era is over. And again, it seems that in the future, we may look back and see 2020 as the year in which the Reagan era really ended. And when it relates to fiscal policy, this slide gets to something that I think was candidate Trump's really big insight when he was running for the Republican presidential nomination in 2015, 2016. He realized that a lot of the potential Republican electorate wasn't going to get excited about cutting the deficit, wasn't going to get excited about trimming the budget or repeating the refrain from the Reagan years of limited government. That what people really wanted was that they wanted to get theirs. And that this chart really shows it. So there's a lot going on here. But on the left-hand side of the page, it's views on immigration. On the top of the page, so the columns, it's views on Social Security. And in the bottom right, when you combine more or the same amount of immigration with decreasing Social Security, what we've termed sort of business Republicans, but I would argue is kind of more of that Reagan legacy, sums to 4%. In the upper left, the rectangle that wanted to reduce immigration and keep Social Security the same or make it even larger, summed to 40%. So that, yeah, candidate Trump sort of had this field entirely to himself. And I think that when you really reduce this to 2 people, this is why Donald Trump won the nomination and why Jeb Bush was an afterthought 2 or 3 weeks into the election, or 2 or 3 weeks into the campaign. So that this signaled a shift for the Republican Party away from being the defender of the budget, the defender of limited government, and not spending beyond our means. And if you flip to page 2, Ronald Reagan, I was a kid, but I remember him well. He's called the great communicator. And he was this avuncular presence. He was funny. He had a quick wit. He could, in the give and take of a live press conference, be funny. And he was really comforting. I was not alive for FDR, but it was almost like FDR's fireside chats when Reagan spoke to the nation. So he was enormously influential, so influential that we say the Reagan era didn't end until 40 years after his first term, because even Democratic administrations like the Clinton administration and the Obama administration had to follow the Reagan administration's lead on keeping an eye on spending. Now, these two charts, or these two panels of a chart, the top panel is a poll of Democrats asking their policy priorities, and it took out all the COVID-19 and the economy and jobs responses that were really hot button issues. Okay, there are 16 responses here for the Democrats, 16 responses for the Republicans in the red bars in the bottom panel. Of course, the budget isn't that big of a concern for Democrats. It comes in 11th out of 16. But it's pretty remarkable that it comes in 11th out of 16 for the Republicans. Again, that insight that keeping a close eye on the budget, having fairly responsible or tight fiscal policy doesn't resonate with the electorate. People don't really care. And with the Biden administration in 2020, now Democrats don't even have to sort of go along with this. Okay, the Clinton administration, it's a famous line when he was being briefed before he took the presidency, that he really had to watch the spending. And Clinton erupted and yelled at the advisors and said, "You mean the success of my administration and my economic policy is in the hands of," used an expletive, "bond traders?" He was just enraged that the bond vigilantes could have sway over the grand things you wanted to do. But he had to toe the line. James Carville, that was about the time when James Carville said, I used to think if there was reincarnation, I wanted to come back as Pope or a great leader or a 400 hitter. But now I've decided I want to come back as the bond market because you can intimidate everybody. And then the next Democratic administration with Obama, when his advisors felt like the economy needed way more than the stimulus package that was drawn up in February of 2009, but that the economic advisors said, look, there's no way we're getting anything through Congress that has $1 trillion price tag. So you got to get it below $1 trillion. And the Obama administration gritted their teeth and accepted that advice. Now we're talking about a $3.5 trillion infrastructure plan, or I'm sorry, the thing after the infrastructure bill. And we had the enormous CARES Act. $1 trillion doesn't make anyone blink anymore. So now you have both Democratic and Republican administrations really turning their back on the budget concerns. And we do think this could usher in sort of a continental divide of fiscal policy before 2020 or fiscal policy from 1980 through 2020, the Reagan era, and whatever comes after it.
Doug, do you think that COVID was kind of that catalyst for this budget deficit, lack of concern about budget deficits? Creating $1 trillion price tag just dwarfs what happened during the Great Recession, the financial crisis in 08-09.
Absolutely. I think it was a really important catalyst, but I do think beneath the surface, candidate Trump and his advisors recognized that this is where we were going, and that this shift had already occurred within the electorate where the electorate would accept it. And then you just had, okay, COVID was sort of the catalyst, that was the proof of concept.
And you talked about previous administrations' concerns about bond vigilantes. And again, just for everybody's information, that's kind of thinking about bond traders kind of being able to force yields one direction or another and create a reaction from either the market or the government. But thinking about where we are now, why do you believe that if we had that same type of action, that there would be a different reaction from the administration currently?
Sure, look, that's a great question. And surely there is a level where the bond vigilantes would come out of hibernation. So just as you described, what we think of with the bond vigilantes, the bond market would sell bonds, put a lot of pressure on treasuries, and thereby make treasury yields go up. And as treasury yields rise, that would constrain the federal government's ability to spend, because more and more of the budget would have to be diverted to interest payments, and it would make every succeeding initiative more expensive when you had to borrow money to put that initiative into play. So there surely is a level, but it looks like it's a ways away. When we've got the 10-year yield, between 130 and 135 this week. And gee, we've got inflation that's coming in at 3% or better on a year-over-year basis. So in real inflation-adjusted terms, we're talking about a real 10-year Treasury yield that is more than 1.5 percentage points below zero. And that's not a constraint for anyone. So it's going to take a big rise in Treasury yields to get to the point where we think you would see interest rates become a meaningful constraint for fiscal policy. That could change on a dime, but we don't think that that's coming, in the next year, even in the next 2 years.
So if we're in this period now where rates might not be rising in the near term, but we do have growing budget deficits that seem to be endorsed, I'd say, by both sides in some respects for many of them. You and I had not discussed this in advance, but it's beginning to sound to the average layman, maybe the idea of MMT is creeping in, something like that, which I know maybe has. You talked about yields being a potential kind of inhibitor, and kind of a cap in yields might be causing an issue. Inflation on the MMT side, what a lot of people talk about is inflation will be the limiting fact on how far you can push borrowing and spending. What are your thoughts on that?
Sure. Again, inflation was the catalyst the last time around when we saw bond yields really take off in the 70s. And just so everyone can see what happened with bond yields, if you'll please go to the third slide in the pack. Okay. We have, this is the 10-year Treasury yield. It really, really takes off. That slope gets really steep once we get in the mid to late 1970s. We do think some things are different now, and it is really unlikely that we could have the wage price spiral to the extent that we did in the 1970s. And when economists talk about the wage price spiral, it's simply that people getting paid more led to prices going up, which led to people getting paid more. So you had this vicious circle, this self-reinforcing dynamic in which wage prices pushed up consumer prices, which went back to pushing up wage prices, because in many union contracts, workers had these cost of living adjustments that they got a raise. They had negotiated for their 5-year contract, say, an increase in their annual salary, annual wages, based on how much the cost of living went up, and that cost of living was tied to the year-over-year change in the consumer price index. We don't have that sort of feedback loop now, simply because organized labor is so much weaker than it was in the 70s. And we don't have the dependence on oil for the economy that we did then, so that when we had a couple of embargoes, when big oil importers reduced what they were sending to the United States, we wound up with gas lines, etc., and prices surged. When you had unchanged demand, but much reduced supply. We think that, again, the economy isn't as susceptible to prices rising at the rate that they did then, but we do think the law of supply and demand still applies, and that if fiscal policy generates a big pickup in demand across the economy, and there isn't a concomitant increase in capacity, in the ability to meet that demand, then presumably you will have upward price pressures. And we do think they may very well be coming, but not for, say, another 2-3 years out. So that we think we're going to see inflation concerns diminish and prices begin to come down as we work through the bottlenecks that have emerged when we suddenly tried to restart the global economy. But we don't think it's gone for good. We do think it's still potentially lurking out there, and that yes, it too could sort of slam the brakes on what Washington, D.C. is able to do in terms of spending.
So just to kind of repeat what you just said and your conclusion currently is that you would be in the camp that the current level of inflation is transitory, but on the horizon, you do see a period where we will get to higher sustained inflation than what we've been used to for the past couple of decades, really.
Absolutely, yes, that is well said, and therefore we think that that's a place where we have a non-consensus view, because it does seem that in terms of the way we're looking at it, markets may be being complacent about what could be coming.
So let's quickly pivot to kind of thinking about, we've talked about fiscal policy on the first two slides. This, we begin to get into some monetary policy. Lots of talk about growing budget deficits, lots to talk about inflation currently, inflation on the horizon. From an investment strategy perspective, what does that lead to in terms of where are potential pitfalls and where maybe you see opportunities in the coming, let's call it 12 to 36 months?
It makes me hate treasuries, especially treasuries at the longer end of the curve, because they are most susceptible to losing value as interest rates rise. And we do think interest rates are going to rise. We think they're going to rise steadily and meaningfully. And that, so it does make us not really want to own treasuries. The treasuries that that someone would have in a portfolio, we think should be geared to the shorter end of the curve. The 2-year, the 3-year, even bills, as opposed to going further out the curve where you are going to be susceptible to more losses. We also think it argues for a weaker dollar over that 12 to 36 month time period, and therefore it may make sense to shift some allocations from US assets to assets outside of the United States. Because if, for example, the dollar is going to weaken against the euro, an American investor has a built-in tailwind from owning European stocks versus owning US stocks simply by virtue of that translation effect, right? From the shares in euros being worth more in dollars than they otherwise would. It makes us too, as a firm, kind of like value over growth, over that 12 plus month time frame, because there are stocks within that get that value designation. A lot of financial stocks, banks, life insurers, property and casualty insurers, those companies would benefit from higher interest rates. And it may make an investor want to lighten up a little bit on his or her tech exposure, because the tech companies that are expected to have very, very large future earnings relative to your average stock, as interest rates go up, the value of the future earnings stream diminishes. So tech would also have a headwind if we had higher interest rates over the next, if interest rates just march higher over the next couple of years, it'd be a tailwind for banks, it'd be a headwind for big tech companies.
Glenn, do you have anything to talk about in terms of other opportunities you may see based on what Doug has conveyed here so far?
Yes, PJ, thanks. Doug, I guess, looking at this chart and talking about what a great time it was, from the early 80s, the disinflationary period, and how it was great for markets. I guess if interest rates are going to rise over the longer term, or at least that's what we expect them to rise in some fashion, obviously it could be challenged for a while. It seems like we need some kind of economic growth. Obviously, the debt we talked about, the borrowing, maybe relaxation on some people's minds about short term, letting that grow a little more. It's going to be measured against the size of the economy in a lot of regards. Any thoughts on what may be underestimated, or just some surprises we may see on the economic growth profile as we look forward over the next decade or so?
Well, in the near term, we're actually quite optimistic about growth. And when I say the near term, through the remainder of 2021 and all of 2022, one thing that I think is really important to recognize from the fiscal spending that occurred last year, especially the fiscal spending that took the form of transfers from the federal government to households via there's a $600 payment for adults and for dependents as part of the CARES Act, $500 for adults and dependents at the end of December. Then we had $1,400 for adults and $1,200 for dependent in March of this year. In addition, we had April, May, June, July of 2020 from the CARES Act, $600 federal unemployment benefit supplements. Unemployment benefits come from the states, but we have that $600 coming from the federal government weekly. Then we've had another $300 that is going to go away once Labor Day arrives. It ends from the federal government. Some states have pulled out of that. We're pulling out of it in June and July. But that all of this money that got sent to households, and it was about 70% of households that qualified for the full payments of each of these rounds of payments. It didn't get spent. And it largely didn't get spent because we were really restricted in where we could spend it, right? We couldn't go to restaurants, we couldn't go to movie theaters, couldn't go to concerts, couldn't go to ball games, we couldn't really travel. Well, so people had more money coming in and less money was going out. We estimate that in the aggregate, all US households have $2.3 trillion more savings than they would have had if we had had no pandemic.
Wow.
That's a big, big number, even for an economy that's about a $21 trillion economy. That can provide a really big boost to economic activity over, we think 2021 and 2022, even if you assume that only half of it is going to get spent. And so we think things look really, really good through 2022. The trouble then would come if this demand remains, but we don't have the capacity to satisfy it. Then you can get inflation. So looking out, if you're getting the inflation and the Fed is forced to really slam on the brakes, we could have a deeper and longer recession than we otherwise would have. And that could be really tough for equities. If, when that comes, then you would want to own those 10-year and 30-year treasuries so that when we try to look out, I don't know if anyone on this call is a golfer, we see it as a double breaker, a putt that on its way to the hole first goes one way, say to the right, and then will go to the left before it makes its way into the hole. That's sort of the way we see differing time frames now as we try to look out, say, 5 to 10 years. We feel really good about the economy for the next 2 years. And we actually think, despite the strength of the economy, inflation pressures will abate. But we're afraid then the green breaks the other way. And things could get a lot rougher, so that when we think about specific investments, it's really over these timeframes that we have one view for 1 year about positioning and then other views for longer term. And I guess I should add one thing. I know your heritage, there's been a lot of property investing and that you've been very successful at it for clients. Owning real property is an inflation hedge. It has been in the past. So that, something else I think we should be doing when we think about portfolios for that 5 years out is looking for assets that will retain their value better than others if we do enter an inflationary period, and that may even outperform considerably on a relative basis. That's a way to try to get out ahead of some of the dangers that could be lurking. I guess it's worth going just to page 6 of the pack because this puts sort of in a picture how we are summing it all up. There's a table on the last page before the disclaimers from BCA and Stearns. One more page, if you would please. All right. This is how we're thinking about the longer term. And of course, many things can change when we get to the longer term, and the farther out a human being tries to look into the future, the worse his or her predictions get, the less accurate they're likely to be. But in the left-hand column, we have what 5 different asset classes have delivered in terms of an annualized return since 1990. And then the little section at the bottom shows inflation. So we're backing inflation out of that bolded nominal return of 8.4% left-hand column to come up with 6.1%. Over the last 30 years, a balanced portfolio, when we say balanced, we mean balance between stocks and bonds, that was 70% equities per the weights that you see in the far right-hand column, and 30% bonds, would have delivered a 6.1% annualized return after inflation. That's really fantastic. Well, if you can think back to the 10-year Treasury yield chart on page 3, which had 2 arrows on it, right? One going straight up from the end of World War II to 1982, and then one going straight down at about the same slope from 82 to today. These fantastic returns over the last 30 years were achieved while we were on that downslope, which represents a darn near gale force tailwind for both bonds and stocks. Even if rates went nowhere the next 5 years, financial assets would be losing a really big tailwind. If they rise, even slowly, they're going to pick up a headwind. And that informs, to some degree, where we are in the right-hand column, where we are guesstimating. Don't want you to think we really can see 10 years into the future. You know, but we are, all right, our best guess, you can get about 4% before inflation over the next 10 years from that 70-30 portfolio. But after you back out increasing inflation, say 3% a year, you're left with 1% real, 1% after inflation. And that, you know, you can see in both treasuries and corporate bonds, because they are projected to be 3% or less before inflation. If we have 3% inflation, you're either going to break even in terms of purchasing power of your capital after you invest in them, or you're going to be behind in terms of purchasing power. So we do think we're looking at a very different landscape over the next 10 years than we have over the last 30. Now, what's in this, the asset classes that are shown here, it's all publicly traded stuff. So there may well be an argument for seeking out things away from the herd, some things that are more difficult to identify, perhaps more difficult to hold. If that keeps some people away, if that keeps some capital away from investing in these spaces, the returns in those spaces might be better.
And so just for the audience, that last section Doug's talking about is thinking about, and again, some of these asset classes or sub-asset classes are definitely only available for certain investor types, certain investment levels. So you have to meet the qualifications, but something like a private equity, like a private real estate we've talked about, venture capital, very out there on the risk curve, but the potential to make money by investing earlier in a company. Other areas, private lending, where you might be doing more direct lending with some leverage involved. Again, each one of these has its own risks, but given the nature, you know, they do stand the opportunity to outperform something, especially like what you see from bonds here over a multi-year period. I think, Doug, what stands out to me is you showed that graph, and it's clear with interest rates just coming down from, 1982, I think, when they peaked, from the perspective of, People back then, might say, I don't want to invest at 16%. I want it to wait to get to 20%. But you look at that 30-year hold period, what you can make. We just can't do that today. Looking out the front windshield, it's just not possible from a math perspective with where rates are today. Can you explain to the audience, one thing I was struggling with is looking at 10-year treasuries, 0.7% going forward, obviously with us trading around 1.3 today, expecting treasuries to rise. We talked about that earlier. But with corporates bond spreads so tight, how are we getting to 3% on corporate bonds in this picture?
Sure. Well, remember that's only a nominal number. And so when you combine investment grade bonds, so sort of the better, the less risky borrowers, and rated by the rating agencies, this is BBB and above. You're getting that's investment grade. It's a little more than 1 percentage point over treasuries. So the coupon there, if we're at 1.3, 1.35 right now on treasuries, if you get paid back in a timely fashion, you're earning 2.3 to 2.5% on them now. High yield, the spread is close to 3%. So you're earning about 4% on high yield. Again, in terms of the yield, if you get paid every dime that you're supposed to get repaid on time. There's more investment grade than there is high yield. So when you squish together the 2.5% roughly investment grade with the 4% high yield, you can get to a 3% coupon. Now, we don't think the coupon being the yield that you receive as the lender, as the bondholder, we don't think those rates are going to stay down here forever. So over that 10-year period, we're expecting that rates are going to rise a little bit, so that, again, what you get if you get paid back on time is going to be something more than what it is today. But of course, we have a recession somewhere in the future, there are going to be higher defaults. Okay, so what's going on here is the yield you get when you buy the bond, some estimate of just how much you're not going to get paid back. And for the ones that don't get paid back, an estimate of how much money you're going to end up recovering. It's very rare to get zero, especially if you lend to a manufacturer or something where there's actually equipment, property and equipment that could be sold. So there are default estimates in here. There are guesstimates about what is going to happen with the overall level of treasury yields, and then what's going to happen with the spread over treasury yields. You mix all that together, we get to 3% nominal.
And also, let's just take a moment to look at the top couple lines. I think most people do know about the U.S. being the leader over the past couple decades. You look at this past decade, just the strength of the technology sector alone. When you look at, we discussed this on these live chats before, that you look at the sector makeup of the EFI or the developed market in Europe and Asia. You look at EM equities, it's just not as tech heavy. There's more financials, there's more cyclicals, things of that nature, which have struggled in this environment as you've seen tech perform so well. And so, as you mentioned earlier, your BCA's belief that you do potentially see the value outperformance that's going to benefit equities outside the U.S., given the overall makeup of their stock markets, along with what we talked about, the tailwind from potential a weaker U.S. dollar. Is that fair to say, how to describe potentially what's going on here?
Yeah, I think you got it. Yeah, it's largely sector composition, the makeup of the stocks within the indexes, and the expected currency move that we do expect the dollar to weaken, and we always state returns in U.S. dollar terms. So we all common currency, so we put everything in, make it apples to apples and oranges to oranges. So, like you said, the currency does factor in here as well.
Doug, I guess the takeaway I have from this, and this is kind of the message I think we're telling folks, is, when you look at kind of the takeaways I have, you think about bonds, and we're basically saying you're probably going to have to underweight bonds and look for other areas, and that basically incentivizes you to assume more risk. And then you're needing to look beyond the U.S. stock market, take a more of a global perspective when you think about stocks. And also, you need to probably consider real assets and or private markets. Is that kind of the main takeaways?
Absolutely. And I guess, so it's not so much doom and gloom, because historically you haven't wanted to bet against the United States, you haven't wanted to bet against human beings or capitalism. Every individual market that doesn't do well, or individual stock or individual investment that doesn't do well, perhaps on the flip side, there's something that is going to do well. So that I do think, all right, icebergs, perhaps there are opportunities in icebergs, right? It's not all negative. And just as you suggest, we can try to find alternative ways to make money. I'll add here, I think this is such a vivid way of describing what happens in markets. And I think it's great advice for anybody to just, as an investor, to think about. This is from the late Barton Biggs. He was strategist at Morgan Stanley for many, many years. Barton Biggs said, there is no investment idea that is so fantastic that it can't be destroyed by too much capital. Once everybody believes the same story, that a particular asset is great or a particular company is great and it's a surefire winner, there's no one left to buy it, right? Everybody's bought it, they've driven the price up, and a lot of our returns in the future depend simply on what we paid at the beginning. And when something gets really, really popular, there's no marginal buyer anymore, and that valuation gets really, really high. And embedded in that valuation are expectations that this is something that absolutely can't lose. It's going to be great forever and ever and ever. Same thing happens on the downside, right? If everybody hates something, then possibly there's a great opportunity to be involved with it. So with that sort of too much capital can be destructive to future returns, trying to get off the beaten path, I do think is a reasonable thing to explore, especially given all of the money that has stacked up on household balance sheets and all of the money that is stacked up for corporations. We're just flooded with cash everywhere you look, whether it's businesses or individuals. And it's not just the United States, it's darn near every developed economy around the world. So that, again, trying to get away from the herd, take that path least traveled, I do think perhaps in the future that could make all the difference.
Yeah, I think we're always trying to consider the risk side as well as the return side of the coins, and just thinking about that risk adjusted return prospect. And so as we've kind of underweighted bonds here at SFG, we try to think about, are there any kind of in between strategies that maybe we're not getting stock like risk, but maybe something in between to kind of buffer? Because obviously if you're an older or just more conservative investor that's, hey, I can't afford a big drawdown, leaving bonds is a little bit disconcerting at times. And so just try and think about the right balance.
We did promise the audience five trends, so we want to talk about. I know we've spent a lot of time on two so far with monetary and fiscal policy, and really kind of getting to the conclusion on this slide, which was very important. Can we spend just a few minutes, Doug, with the time we have left to discuss? I know we want to discuss labor relations, and then we want to touch briefly on cybersecurity and climate change.
Sure. So we'll try this perfect slide to start for the labor relations. I think you can look at this too as another end of the Reagan era. There was a Reagan era in labor relations, and it began when he became the face of crushing the air traffic controllers union when it illegally went on strike in 1981, early in Reagan's administration, and that really inaugurated 4 decades of organized labor being routed in the United States. Well, we think perhaps there may be a shift, that maybe those 4 decades are about to come to an end. I do have to point out there's one mistake in this chart. The left-hand bar, so there are 3 bars here of Gallup polling results of share of workers who would like to join a union. The first bar on the left should say 1977. I don't know how 97 jumped in there. So this is 77, 95, 2017. after being pretty much unchanged from the really peak for unions, or right at the beginning before their demise in the late 70s, not that many more people wanted to join a union then in the late 70s. Really didn't change till the mid 90s. 2017, darn near half of workers say they would like to join a union. Now, it's not as simple as all that. As we saw that Amazon won the election at the plant in Alabama handily. It wasn't even close. But there does seem to be a softening of the overall view in the country towards unions. And then if you'll go to the next page, this chart, and this is from the time of the Democratic primaries. So this is early in 2020, just when we, Iowa and New Hampshire, right around the time when Iowa and New Hampshire were voting. This breaks out likely Democratic voters' preferences among the candidates by age. So we have 4 age buckets here. The first one, for the first 4 bars, 18 to 29, then 30 to 44, 45 to 64, 65 and up. The dark left-hand bar, that dark blue left-hand bar, is support for Bernie Sanders. The green bar right next to him to the right is Elizabeth Warren. Then that sort of off blue bar, not quite Carolina blue, but getting there, is Joe Biden. And then gray aggregates all the other aggregates like Buttigieg, Senator Klobuchar, Michael Bloomberg. Look, young people always are going to tilt, more liberal. I don't know if Churchill really said this. I always heard he did, that if you're not liberal when you're young, you have no heart. If you're not conservative when you're old, you have no brain. So there is surely a shift over time. Okay, so always the younger voters are going to be the most liberal. But man, when you add together the Sanders and Warren bars for the 18 to 29-year-olds, that's 70%. When you add them together for even 30 to 44, so some of the older millennials and some of, I guess, Gen X, Gen Y before them, you got about 60%. And this is somebody, in terms of Senator Bernie Sanders, who has identified as a socialist for all of his time in the Senate. He caucuses with the Democrats, but he says, I'm a socialist. And you had, darn near half of people under 29, which are about to become the largest group. The millennials are going to become the largest group as the baby boomers experience some attrition. They are open to some views that, even when I was in college, would have been extreme. So that what I think that we're seeing is there's a real hunger to go back to sort of New Deal policies. And if you think of the Reagan era lasting 40 years, from 80 to 2020, the New Deal lasted close to 50. From 1933, when FDR took office, through 1980, until Reagan took office. And that we are potentially looking at much more openness to government intervening to try to level the playing field between management and labor. And the big investment takeaway there is, if people get paid more, if wages rise, then corporate profit margins necessarily fall. And if corporate profit margins fall and corporations don't make it up by doing more volume, by selling more goods, then you're going to see corporate earnings fall. And that, all else equal, is negative for stocks, or shouldn't say fall. You are going to see corporate earnings fall relative to what they would have been if wages hadn't risen, and therefore earnings growth begin to decelerate. That it'll still grow year over year, but at a slower rate than it has in the past. And since stock prices are simply the product of the product P equals E earnings times P over E, the PE ratio, or how much investors are willing to pay for each future dollar of earnings. And we are at all-time highs for that PE ratio, except right before the dot-com bubble. So we're already paying a lot for those future earnings. Presumably, that price earnings multiple is going to fall because this is a mean reverting series. When it gets too far away from its average, it comes back. And so I would think that valuations are going to be a headwind for equities. And now a revived labor movement could potentially also be a headwind for equities and could contribute to the reduction in our projections of equity prices going up 10% a year to going up 4% a year. That's a big difference.
Yeah, I think we're already seeing some of that wage pressure just from coming out of COVID and the reopening, and just with some of the stimulus benefits, you're just labor shortage in many areas. There are people out there that could be working, but they're choosing not to, or they've moved to other fields or whatever it is. But like you're putting on this page, if the electorate votes for a more, I guess, liberal policy from the perspective of moving further to the left, you could see mandates come out at the federal level or state levels that also force up the wages. And again, that's going to just compress profit margins in the long run if they can't pass along those increased wages in forms of higher prices, which is going to be very kind of difficult to do.
That's absolutely right. Just a real quick aside, I don't want to derail us. I know I get too interested in this stuff. The executive branch has quite a bit of power in terms of labor relations. It appoints the head of the Department of Labor. It appoints the head of OSHA, Occupational Safety and Health Administration. It appoints the head of the Department of Justice. So that Attorney General then decides just how vigorously the Department of Justice is going to pursue antitrust enforcement. The head of the Department of Labor, the Secretary of Labor, decides how vigorously the laws that are on the books that were largely put on there in the wake of the New Deal are going to be enforced. The outgoing Secretary of Labor was one of Justice Scalia's sons, who it was remarkable the actions he took in his 2 years as Labor Secretary to really dilute the provisions that were on the books and then to just not enforce them at all. Well, we've got a complete about face now in this administration where we've got the former mayor of Boston, who before he became mayor of Boston was a union leader in the construction industry for 20 years. And if the Democrats don't hold the White House in 2024, this might just be a blip. But if the Democrats win again in 2024, I do think we could really see a sea change in those sorts of policies, and that it could begin to show up in union membership and in wage gains.
No, that's great, Doug. As we come up on the top of the hour, and I know we're going to wrap this up in a few minutes, but we did want to touch briefly on cybersecurity and climate change. What thoughts do you want to provide on either of those topics?
Just that opportunity creates winners and losers in different segments. So while the need to really shore up our cybersecurity defenses will be expensive for some companies and presumably lead to smaller profit margins, there are likely to be some big winners, the companies that are selling that protection. As far as climate change, I do think it's worth just thinking about, gee, could one location win at another's expense? And if so, what does that mean for the stock of properties located in the winners versus the losers? I just read closer to home for y'all. I just read an article in the New York Times about 2 or 3 weeks ago that homeowners in Charleston, South Carolina, because of rampant flooding in Charleston now, this is remarkable. This is a thing. People are having their homes razed, and it's not a crew of former Clemson offensive and defensive linemen, with 2x4s, all around the property, like using a lever to lift them up. That these are battalions of cranes that are synchronized to the inch, and they lift the house together. And the folks that were profiled in the article, they spent $500,000 to have their home raised. It said in the article this costs $100,000, $500,000, and it said there's something like 30 or 40 other people that are in the process of doing this. That's going to undermine returns to homes in Charleston, and it just makes me think, gee, maybe if I'm going to have a second home, maybe Asheville's looking better than the Outer Banks. And that, again, there may be bad for some places, but it may open up opportunities for others.
And I think we could apply that logic that you just provided across so many different parts of the climate change discussion, whether it's electrified vehicles, whether it's other areas that have definitely been talked about. And you're seeing it right now with fires, which, we have scarring across the U.S., especially the Western U.S., which led to flooding this year. And there's just it's just a kind of a spilling down a hill effect, a snowball effect of these issues. And so thinking about how that may affect a property investment like you described, thinking about how that may affect an investment in some area of electrified vehicles is definitely important. And there's lots of opportunities. There's also a lot of pitfalls out there.
Put in a quick plug for our commodity and energy team. Those guys absolutely love base metals, because they say if we're really going to have electric cars in any meaningful way, and they're pretty skeptical about the speed at which that can happen, they say we're going to need so much more copper than we have on hand right now, that they're pounding the table for the base metals on a 5 to 10 year view if Europe really follows through with the things it's talking about, and with the United States does as well.
And I guess we did receive one direct question from the audience, and I don't know if he wants to touch on this. We're definitely going to walk a fine line with compliance of not making any recommendations, but kind of piggybacking on the discussion of climate change. And there's been a lot of discussion on the energy usage being required for cryptocurrency, but there was a question about what is the future of cryptocurrency. Anything you want to say there without going too far the recommendation?
Boy, this is such a pitched battle within BCA that we have some people who really think cryptocurrencies in general could be a great investment. There are some people within BCA who think it sounds like utter nonsense. Maybe I'm too old. I am more towards that utter nonsense continuum, but this is something I haven't gotten my head around yet. But I personally, it seems like it's a solution in search of a problem. I don't quite understand why we need something other than dollar bills or wiring money denominated in dollars from our accounts. That seems to work really, really well to me. So I'm sorry, I guess I'm kind of evading the issue, but I honestly don't have an opinion. I haven't dug into it, and the disparity of opinions within BCA among people who do have an opinion is wider than I've ever seen on any other topic.
I actually think that's a very fair answer. There's a lot, I think, of potential usage for the idea of blockchain, but in terms of individual cryptocurrencies, definitely do not want to make a recommendation on this podcast. We received one other quick question about what company you mentioned a few minutes ago. I do not believe Doug mentioned a company with regards to base metals. He was talking about the research team within BCA. It is positive on base metals, but there was no specific company mentioned with that regard.
Yes, yep.
Glenn, anything to add before we wrap up?
Well, maybe just, Doug, as you kind of look forward and kind of thinking about your thesis, your kind of strategic view, any major things you're looking for that might cause that view to be adjusted? And you mentioned demographic trends earlier and the baby boomers being very powerful, but now the millennials being such a big force or a large cohort. Any other factors that you're going to be watching?
Just in the near term, this isn't such a long-term one, but I mentioned that we're pretty bullish on the economy, pretty bullish on stocks over the next 12 months, and even on credit, on borrowers that aren't the U.S. government. But look, that is subject to the COVID-19 just sort of petering out, which is our base case scenario. While this Delta variant is apparently really contagious, it doesn't seem to be all that serious. And it also does not what we know now, it has not managed to get around the vaccine's defenses. If there are subsequent variants that are able to evade the vaccines, then that's really going to slow down. When I'm talking about really strong growth through 2021 and across all of 2022, that's subject to there not being, there not being a variant that can get around the vaccines. But otherwise, we do kind of have that double breaker that things look good over the next 18 months, and then we'll see if some of these more adverse longer term trends begin to assert themselves.
Well, we're almost at the top of the hour. Doug, definitely appreciate you taking the time this morning to be with us. Definitely enjoyed the insight.
Thank you very much for inviting me. I really enjoyed the discussion.
Sounds great. And as always, this recording will be available on our YouTube channel in the near future, and we hope everybody has a wonderful weekend.